$4,100. That is what landed in our account last month while we slept, ate dinner, ran errands, and just lived our lives, not from a job, not from a side hustle, from a portfolio that we built intentionally, strategically, and patiently. And today I'm cracking it completely open for you. Every account, every number, every distribution, every single thing that changed this month, why it changed, and exactly what we are doing about it. Because here's the truth. Most people who talk about passive income online make it sound clean and simple and frictionless, and it is not always that. There are months where distributions drop, there are holdings that are down, there are decisions that need to be made, and the only way you actually learn how to navigate this stuff is by watching someone do it in real time, with real money, with nothing hidden. So that is what today is. Raw, unscripted, real. If you are new here, hey, welcome to the Dividend Desk, where we talk about investing for financial independence with balance, and that word balance is everything on this channel, because what we have built is not just a retirement plan you crack open at 65. It is a portfolio that is actively funding our lifestyle right now, covering rent, utilities, real living expenses, while simultaneously growing for our future. We have an income-oriented account that started with an original investment of about $375,000, and that account has been generating an average of $4,400 per month in passive income this year alone. And before we go any further, I have to say, this content is purely educational. It is not financial advice. All investments carry risk, including the potential loss of your capital. Past performance does not guarantee future results. Please, consult a certified financial planner before making any investment decisions. We are just sharing our journey as openly and honestly as we can. Now, let's start where we always start, the complete snapshot of everything we have invested. And honestly, at the top level this month, it is a quiet one. Our overall investable assets are essentially flat. The covered call ETF account is slightly up, the growth brokerage account is slightly down. The retirement accounts are holding steady, and when you stack that up against what the broader market has been doing, pull up SPY and QQQ over the past month and they are also about flat. Maybe nudging slightly negative depending on exactly which days you are measuring. So we are pacing with the market, which during a sideways stretch like this is exactly where we want to be. Flat is not failure. Flat is discipline working. But before we get deep into the income account, I want to spend a real moment on the growth side of the portfolio because I think this context is important for everyone watching. We are not all in on income investing, not even close. Our allocation is roughly 30% income-oriented and 70% growth-focused for the long term. That 70%, that is the wealth engine that is going to carry us into retirement in a significant way. It includes an IRA and a Roth IRA that came from years of corporate employment. That Roth started back in 2007. Early on it was sitting in a target date fund, which is a perfectly reasonable starting point, but over time we migrated it into broader diversified assets. S&P 500, total U.S. stock market. The kind of holdings that do not make headlines but quietly compound into life-changing numbers if you leave them alone long enough. And this is actually where I want to pause and say something important, something we talk about a lot here at the Dividend Desk, because it is a planning trap that catches more people than you would think. Some investors have actually over-invested into their retirement accounts. And I say that not to be contrarian, but because it is a real issue. If you pile everything into tax-deferred accounts, you may face heavy tax burdens later through required minimum distributions. And if you have early retirement goals, and a lot of us do, you need to be aware that you cannot touch those retirement accounts without penalty until you are 59 and a half. So eyes wide open on that. Know your goals, know your timeline, plan accordingly. Now, we also have a growth brokerage account that we started building seriously in 2021, when significant portions of active income were going straight into the market every single month. That account is sitting at a little over 300,000, trending toward 400,000. And the holdings that are still in there, the ones we bought and simply held, have grown 69%. 69%. That is the power of buying, holding, and getting out of your own way. All right, now let's get to the part you actually came here for, the income account. The one that is writing us a check every single month. This account started with that $375,000 original investment back in early 2023. Right now the current value is sitting in the $350,000 range, and the reason it is below our original investment is almost entirely due to one holding, BTCI. Bitcoin is down. BTCI is down with it. We will talk about that. But here's what matters. Even through that, this account has generated an 8% distribution return in 2023, 10% in 2024, and 14% last year. So let us get into the specific numbers for this past month. GPQ paid us $643, SPYI came in at $755, QQQI added $176, and BTCI contributed $54. Total for the month, $4,100 flowing into our accounts. Now, if you have been following along from last month, you already know that both JPQ and BTCI came in lower than they did the prior month, and I want to address both of those directly, because understanding why matters just as much as the numbers themselves. Starting with BTCI. This one was fully expected. Bitcoin has pulled back significantly. It was down about 44% from the original purchase point back in July of last year. As the underlying asset declines in price, the distributions naturally decline in dollar terms as well. But here is the really important distinction that I want to make sure everyone watching understands, because it completely changes how you should be thinking about this. The rate of distribution, the percentage being paid relative to the fund's price, has actually remained remarkably consistent. When we dug into the data and looked at BTCI's entry and exit price every single month alongside the dividend history, the monthly distribution, divided by the closing price for that month, averages out to roughly 2.4% per month. That rate is holding. What is falling is the dollar amount, because the price of the fund has fallen. The mechanism is intact. The asset is just cheaper right now, which is actually why we are continuing to buy more. And this brings up something that I think is one of the most important concepts in all of income investing, and it is something a lot of people completely misunderstand when they are evaluating funds. It is the difference between distribution rate and 12-month trailing distribution rate, and why relying on only one of those figures can seriously mislead your income planning. Let me walk you through this clearly. If you have a stock priced at $10 paying $1 in distributions per month, that is a 1% monthly distribution, and over 12 months that is 12% annually on a $10 base. Clean and simple. Now let's say the price declines. Let's say it drops by half. If the dollar amount of the distribution stays flat while the price has fallen, mathematically the yield percentage actually increases. The 12-month trailing yield starts to look inflated, even exciting. But here is the trap. That elevated yield may not be sustainable. It is a mathematical artifact of price decline, not a signal that the fund is performing better. On the flip side, if a fund like BTCI declines in price and simultaneously reduces the dollar distribution by the same rate, the percentage stays flat, but the 12-month trailing yield still looks slightly elevated compared to where the fund is actually operating right now. The more accurate number in that scenario is to take last month's distribution, multiply it by 12, and use that as your forward projection. That forward-looking calculation is what we use alongside the trailing yield to do what we call consensus planning. We are not just trusting one number, we are triangulating between what the trailing yield says, what last month's number says, and what we actually received. And we are looking for those 3 data points to tell a consistent story. Now for JPQ specifically, month over month we went from about 58 cents per share down to 47 cents per share. They have already declared next month's distribution and it is slightly higher, which is encouraging. But this variability is the one thing we always want to be honest about with JPQ here at the dividend desk, because it is genuinely one of the characteristics of that fund that you need to plan around. JPQ is a tremendous fund. JP Morgan runs it. It is institutional grade. It strips out volatility effectively. It delivers a strong yield. The income it generates is classified as ordinary income, which makes your tax situation very straightforward and easy to plan for. But the distributions fluctuate. They are not consistent month to month the way that something like QQQI tends to be. And if you are relying on GPQ to meet a minimum income threshold every single month, you need to build in a buffer. If you need $4,000 and JEPQ delivers $3,500 one month, you need a plan for that gap. This is not a criticism of the fund. It is just the reality of how it is structured, and it needs to be factored into your income plan from day one. So let us just lay out clearly what we are holding and why. We have 3 INEOS funds, QQQI, which tracks the NASDAQ 100, SPYI, which tracks the S&P 500, and BTCI, whose underlying holding is Bitcoin, and we have JPQ, which is JP Morgan's NASDAQ 100 covered call ETF. Now, a question that comes in almost every single month is whether holding both QQQI and JEPQ creates unnecessary duplication since both are tied to the NASDAQ 100. And the honest answer is, yes, there is overlap in the underlying index. But the strategies behind these two funds are fundamentally different. ENEOS uses index options and applies 1256 tax treatment, which carries meaningful tax efficiency advantages. JP Morgan builds their covered call ETFs using equity-linked notes, which generates ordinary income but comes with its own yield and structural advantages. They behave differently in different market conditions. They have different distribution profiles, and for where we are right now, holding both is intentional. That said, some rebalancing is coming next month, so make sure you come back for that portfolio review because things are about to shift. Now on the subject of taxes, because there were a flood of questions about this last month, let us give you the real picture straight from the 1099 statements. For GPQ Holdings, JP Morgan's equity-linked note structure means that the majority of distributions you receive are classified as ordinary income. Not all of it, but the lion's share. That means you are paying taxes on most of what JEPQ pays you at your ordinary income rate. Now compare that to QQQI and SPYI from NEOS. Because they use index options to write their covered calls, they can apply 1256 contract tax treatment to a significant portion of the distributions. On top of that, as the fund harvests gains and losses throughout the year, they can allocate some of those losses against your distributions in the form of return of capital. And when you see return of capital on your 1099, that is not the fund eroding your investment the way some income investors fear. It is a deferral. It is a cost basis adjustment. You are not paying taxes on that portion now. Instead, your cost basis is being adjusted downward, which means when you eventually sell, your taxable gain will be slightly larger. But you have deferred that tax bill potentially years or even decades into the future, and in the meantime that money continues to compound. That is a meaningful structural advantage that does not get talked about nearly enough. For BTCI specifically, there are more taxable distributions compared to QQQI and SPYI, which makes sense given that Bitcoin does not have the same options market infrastructure as the major equity indexes. So when you are looking at your 1099 from Fidelity or wherever you hold these funds, you are going to see total dividends broken out, qualified dividends, ordinary dividends, and then non-dividend distributions, which are your return of capital. What Fidelity will do is automatically adjust your cost basis based on those return of capital allocations. And this is why maintaining independent tracking outside of the brokerage matters, because you need to know your original cost basis, what the adjusted cost basis looks like after return of capital, and how that all nets out at the account level. Right now, Fidelity is showing an adjusted cost basis of about $370,000 for that account versus the $387,000 that went in originally. That $17,000 difference is entirely accounted for by return of capital distributions deferring taxes into the cost basis. Not money lost, just taxes deferred. A very different thing. So, where does that leave us right now at the full account level? Original cost basis is $387,000 after reinvesting some distributions, particularly back into BTCI. Current value is in the $350,000 range with Bitcoin suppressed, down about 10% on paper. But when you factor in total cumulative distributions received from this account, the cumulative total return sits at positive 21%. The account is working. The 12-month trailing yield is showing a little over 15% in personal distributions from this account. The forward-looking projection based on last month's numbers is a little over 13%, so we are operating somewhere in that 13 to 15% band, and with the rebalancing that is planned, the expectation is to maintain that range as we move through the rest of the year, and we are still comfortably inside that $4,000 to $4,800 monthly income range that has become the baseline for this account. $4,100 this month is on the lower end of that range, but it was anticipated, it was planned for, and we keep moving. The priorities for this account have not changed. Number 1 is income. Number 2 is value preservation. Number 3 is tax efficiency. And number 4 is positioning to take advantage of market opportunities as they present themselves. Right now, Bitcoin is discounted. BTCI is discounted. We are buying more. We are bringing the average cost per share down. And eventually, when those higher-priced shares cycle out, the math on this position is going to look significantly better. That is the plan. and we are sticking to it. If you are just getting started with researching covered call ETFs or want to understand how to evaluate growth funds, stockanalysis.com is a great starting point for pulling raw data, building watch lists, and getting the kind of information that feeds a solid tracking spreadsheet. And if you want to go even deeper, the Income 360 file covers over 80 funds, categorized, organized, and structured to help you cut through the noise fast. This week the income tracking template has also been added to that file, the exact one referenced throughout today's video. If you have already purchased the Income 360 file, check your email because you get lifetime updates and that template is on its way to you automatically. The reason that file exists is because the landscape of covered call ETFs is genuinely overwhelming if you do not have a structure to work within. And the single most important lesson to leave you with from everything we covered today is this: do not chase yield. Please. Do not look at a fund showing 30% annual distribution and assume that is sustainable or safe or a sign that the fund is well constructed. Total return is the metric that matters. The structure of the fund matters. The tax treatment matters. Whether the NAV is holding up over time matters. The income is only valuable if the vehicle delivering it is sound enough to keep delivering it. Build your income strategy around funds with integrity, not just impressive numbers on a screen. Next month we will be back with the full portfolio review right here at the Dividend desk, and there will be real changes to show you in terms of how we have rebalanced. Make sure you are subscribed so you do not miss that update. And if today's video gave you even one piece of clarity on how income investing actually works in the real world, hit the like button. It genuinely helps this channel reach more people who are trying to build something real with their money. We will see you at the next one.